Greetings class and welcome to this video for March the 27th. In this video I'm going to go back and revisit a couple of things about Chapter 10 Variance Analysis, then go through the Foundational 15 for Chapter 10. Now with Chapter 10, I'm not going to go into it as deeply. We're going to have some things from that on the next test, of course. But there are some things that I think are very important for you to know, in particular, how you look at variances and how you analyze them. So with that in mind, I want to go back to the PowerPoint. And I've highlighted really 3 slides here I want to address real quickly as we go through this exercise in the Foundational 15. So to start with, the materials variances, we have this slide that identifies materials price variance and materials quantity variance. Now I've highlighted in yellow the formulas that you need to know that I would basically, if I were writing a note card, these are the formulas I would write down. So for a price variance, you're going to have the actual quantity times actual price minus standard price. For a quantity variance, you're going to have the standard price times actual quantity minus standard quantity. That's for materials. But the concept of that will follow very closely with labor, but we're going to call these variances something else with labor. Rather than a price variance, it's going to be a rate variance. And instead of a quantity variance, it's going to be an efficiency variance. So if you look here in this slide, the next slide that I've highlighted, these are the labor variances. And again, I've highlighted these formulas. The labor rate variance, it's very important, is the actual hours times the actual hours rate, actual rate per hour, minus the standard rate per hour. The efficiency variance is the standard rate times the actual hours minus the standard hours. So again, this is very, very similar concept. With this, you're comparing the difference in the price per hour that you pay for labor, or the rate, as we would call it if we're talking about paying somebody a wage. And here we would have a difference in the number of hours used to make a particular product, and that would be an efficiency variance, okay? Now, the last of these slides that I want to highlight is the variable manufacturing overhead calculations. And again, they use a very similar approach. So you see here, the variable manufacturing overhead rate variance is very, very similar to what we saw with the labor rate variance. The actual hours of variable manufacturing overhead in the calculation for it times the actual rate minus the standard rate. Okay, that's very close to what the labor labor rate variance is. Now, if we come down to the variable manufacturing overhead efficiency variance, it's going to be very similar to the labor efficiency variance because we're going to take the standard rate, the actual hours used minus the standard hours, and so we're looking at that difference in the number of hours that we've used. So that really is what I want to highlight from these PowerPoints, and the PowerPoint slides that are currently in the module do not have these highlights, but what I'm going to do is upload this version and replace the one that's there with this, so you can actually look at these formulas. And for what we're going to be doing in the future and for future reference, I would say these are going to be very important for you to know. Okay? Now, the next thing I want to do is to look at the Foundational 15. And I have it in the module in 2 different kind of documents. The first one is this Word document right here, and the second one is a student worksheet, which is really the Excel document that I'm going to go through while we do this. So if we look at the Word document, it's just like looking at it out of the book. The problem itself is stated. We have this company, Preble Company, manufactures one product and gives a standard cost card for it. How many pounds of direct material per unit produced, how many hours of direct labor per unit, how many hours of variable overhead, and the standard prices or costs for those particular items. So With direct materials, you have a standard quantity of 5 pounds per unit with a cost of $8 a pound. That's about $40 per unit. For direct labor, you have 2 hours of direct labor for $14 an hour. That's $28 per unit. And then variable overhead, 2 hours times $5 per hour. That gives you $10 per unit. Our total cost per unit standard is $78. And then they give us these 4 facts about the company. They planned on producing and selling 25,000 units, but they actually produced and sold 30,000 units and incurred the following costs. They purchased 160,000 pounds of raw materials at a cost of $7.50 a pound. All of that material was used in production. And direct laborers worked 55,000 hours at a rate of $15 an hour. And the total variable manufacturing overhead for the month was $280,500. So the first thing they ask us is what raw materials costs would be included in the company's planning budget for March. Well, let's go to the Excel spreadsheet, and we have that here. If we look at the planning budget, we have units of production that we were planning for the month, which was 25,000 units. And then we had a standard quantity per unit of 5 pounds. So we're going to take the 5 pounds times the 25,000. We get 125,000 pounds of material at a cost of $8 a pound. So we'll take the $8 per pound times 125,000. Now I'm just pulling these standard quantities right from this table right here. So when we look at standard quantity per unit, I'm going back here to the line that says direct materials and pulling 5 pounds. Standard cost per unit, I'm going back here and getting the $8 per unit or per pound. So we have $1 million in raw materials costs in the planning budget. So what is in the flexible budget? Well, we're going to look at, instead of the planning budget or planned usage, instead of looking at that, we're going to look at the actual quantity used. So we used 160,000 pounds, and we paid, well, we're going to use a standard price per pound, not what we actually paid, but we're going to use a standard price of $8 per pound. So we're just going to take that standard price times our actual usage, and we get 1,280,000. Okay? So that is the flexible budget based on our actual quantity used and the same standard rate that we used in the planning budget. For number 3, they ask us what the raw materials price variance is. So with raw materials price variance, what we're going to look at is we're going to compare the actual quantity that we use. We're going to take that actual quantity times the difference in the price that we paid versus the standard price. And so you can see I've entered this right here. We have 160,000 pounds of raw material, and we actually paid $7.50 a pound instead of $8. That's right up here in letter B. 160,000 at $7.50. So we take that actual quantity times the actual price minus the standard price. So I'm going to do this. I'm going to take the equal sign minus, because this is going to come out negative, and I don't want a negative number. But we have 160,000 pounds times $7.50 minus $8. We enter, we get $80,000. That's the price variance. That's the difference. That's at this quantity level. That's the difference that the price makes. And since it's below the standard, it's a favorable variance. Okay. Now, for number 5, if we go back over here to the actual problem, it says, what happens if they would have purchased 170,000 pounds of raw material at $7.50 a pound and used 160,000 pounds? What would the materials price variance be for March if they did that? Well, if they did that, we would have the number of actual quantity that we purchased times the price that we actually paid minus the standard price. So we're just going to alter the calculation a little bit. We'll say instead of 160,000, 170,000 that we purchased. This doesn't mean we used it all. It just means that we purchased it at this rate. $750 minus $8. That gives us a variance of 85,000 if we actually purchased 170,000 pounds. I skipped number 4. I'm sorry. This is going to be a favorable variance, by the way. So at $85,000 variance is going to be favorable. I'm sorry, I skipped number 4 because I was just working across, but this is number 5. Now let's go back and pick up number 4. Number 4 is asking us, what is the raw materials quantity variance, okay? So if we're looking at number 4 and the quantity variance, we're just really going to look at the difference between the standard and the flexible. And so what we're really looking at is we're going to use this actual standard price times the quantity we used minus the standard quantity. So if we do this calculation, we have $8 times 160,000 minus 150,000. That's, oh, I put too many zeros in. That's going to be, no, I didn't put enough zeros in. 160,000 minus 150,000. That's going to be an $80,000 variance. But because we used more material than we had in the standard, it's going to be an unfavorable variance. Now that can be a problem with standard costing approaches or standard pricing or standard quantities. Some of this is due to a higher level of sales, production and sales, so that's not necessarily a bad thing, but if you're calculating this compared to the standard, that will come out with an unfavorable variance, okay? So that's the raw materials quantity variance if we are at the standard amount and the quantity that we used of 160,000. Now, number 6 is a continuation of number 5 because remember number 5, it said if they purchased 170 and used 160. So number 6 is the same thing. If they purchased 170,000 at 750 and used 160, what would be the materials quantity variance for March? When we go back and look at this, the materials quantity variance is going to be almost exact, well, it will be exactly the same thing we have here because we're really looking at the actual quantity that we used. So for number 6, it's not going to be any different than what it was for number 4. We have the $8 times 160,000 minus 150,000. And we get an $80,000 variance. And again, because this is above the standard or over the standard, it'll be an unfavorable variance, okay? So that's the raw materials quantity variance. Now, for number 7, they want to know what the direct labor cost is that's in the actual planning budget. So if we go to number 7, we're going to base that planning budget on the number of units that we were planning to produce. So we have 25,000 units, and our standard hours of labor per unit produced is $2, or 2 hours, I'm not $2, 2 hours per unit. So we're going to put in 2 hours and calculate 50,000 total direct labor hours. And then we're going to use a standard direct labor rate, which is right here, the $14 per hour. So we pull that down and we multiply the $14 per hour times the direct labor hours, and we get $700,000. That's the direct labor cost. It's in the planning budget. Okay, so what would be the cost? And that's planning based on a 25,000 unit production, not based on the 30,000 we actually did. So when we come over to number 8, we're going to look at the direct labor cost. It's in the flexible budget. We want to look at the actual hours utilized. Okay, we're not looking at the standard anymore. We're looking at actual hours. So we actually worked 55,000 hours. So if we go here to number 8, we're going to say the actual direct labor hours of March were 55,000 hours. Okay. Now we are going to keep the standard direct labor rate, which is $14 an hour, and we multiply those out. We get $770,000. That's the flexible budget compared to the standard budget. So the standard budget, the planning budget, when we did the planning, we did 25,000, 2 hours per unit, 50,000 hours, $14 an hour, and 700,000. So when we get to the labor rate variance for number 9, we're going to go back to this flexible budget because you notice this is a difference in the level of activity. We had 55,000 hours here in actual activity compared to 50,000 in planned activity. So we come here, we're going to take that 55,000 actual activity times the actual rate that we paid, which if you go up here it says $15 per hour, minus the $14 an hour that we had for the standard cost. So when we calculate this, we're going to have 55,000 times 15 minus 14. That gives us a $55,000 variance. Now, because the standard rate is lower than the actual rate we paid, this is an unfavorable variance, okay? So the number 9 labor rate variance is unfavorable. The labor efficiency variance, however, is going to be based on a comparison between the standard rate times the actual hours minus the standard hours. So here's what we have. If we were producing 30,000 units, which is what we actually produced, and we use the standard hours for those units, that's the actual activity. That's not the planning activity, that's the actual activity. So we had 30,000 units that we produced. And if we use the standard rate per unit of 2 hours, we get 60,000 hours, which would be allowed if we were building 30,000 units. That's a standard number of hours. So for this calculation, I'm going to put minus in here, $14 an hour times 55,000 minus 60,000. Oops, not dots, zeros. And we get a $70,000 variance. This is going to be favorable because this is below what our standard would be to produce those actual 30,000 units. So what we're looking at in labor efficiency is we're saying, okay, how many units did we actually produce? How many hours were we allowed? And how many did we actually utilize? Now, when we go to the labor spending variance, we're just going to take the difference between the efficiency variance and the labor rate variance. Those two are going to give us, the difference between those two will give us the spending variance. So we take the $70,000 efficiency variance, which is favorable, and the labor rate variance of 55,000, which is unfavorable. And that will give us, wait a minute, 55,000 unfavorable And that difference will give us 15,000. Now, because the larger number is a favorable variance, the spending variance will also be favorable. Okay? All right, so basically, when we're talking about spending variance, we're talking about the difference between the efficiency and the labor rate variance. And that gives us a favorable spending variance of 15,000. Okay, so let's take a look then at number 12, which is going to be the variable manufacturing overhead cost in the planning budget. So we go down here to number 12. They say, well, what is the variable manufacturing overhead cost that would be included in the company's planning budget for March? All of this is going to be based on the standard. So the production that we planned in March was 25,000. So we had 25,000 units planned. Our standard hours per unit for overhead, if we go back up here, is 2 hours per unit. Look at this, 2 hours per unit. So we go back down and we say, okay, we got 2 hours a unit. That means we have 50,000 hours in variable overhead. So, well, if this will cooperate. So I have 2 hours per unit. And I'm going to multiply these two to get 50,000 variable overhead hours. Now, the standard cost per hour that we had up here was $5 an hour. So we're going to put that in here, and we'll do the math here. We'll multiply $5 times 50,000. We get $250,000 in cost in the planning budget for the variable manufacturing overhead. Okay. So when we look at this, we're looking at, okay, what was the actual plan? What would be the flexible budget? All right. The flexible budget variable manufacturing overhead cost. Well, we need to do a little bit of a calculation here in order to get this. So we have 55,000 hours, which was what we actually spent. If we go back up here, you'll see this. We're basing it on direct labor hours. So we're using this 55,000 direct labor hours. And we have a standard variable overhead rate for that of $5 an hour. If we go back up here, that's what the rate was. $5 an hour for the rate or the price. So we're going to go down and calculate 55,000 times $5 to get 275,000. So that's the difference between what we have in the actual overhead hours compared to the standard rate. That's in the flexible budget, 275,000. That's based on the higher level of hours. The planning budget was based on 25,000 units at 2 hours a unit, 50,000 hours, or $250,000. Now for the next one, the variable overhead rate variance, we need to do an extra calculation. So the first thing we need to do is to look at the variable manufacturing overhead costs. They give us this up here in this table. Well, not table, down here. They give us 280,500. So we have variable manufacturing overhead cost is going to be 280,500. Okay, that is the actual variable manufacturing overhead cost, and we're going to divide that by the actual hours, variable overhead hours, and that's the 55,000 we had here. Okay, so this is the 55,000 actual variable hours. So in order to get this actual rate that they ask us to look at, we need to calculate it. We do the variable manufacturing overhead cost. That's what we actually spent. The actual variable overhead hours, that's what we actually spent. And we get an actual variable overhead rate. And this rate will be 280,500 divided by 55,000. We get $5.10 per hour. So that's the actual overhead rate right here, okay? So we need to calculate that before we can actually do this variable overhead rate variance. So in this case, we have a $5.10 hour per hour rate for overhead. And we're going to actually use that in this calculation. So here, for the variable overhead rate variance, we take the actual hours of 55,000 times the actual rate of $5.10 minus the standard rate of $5 to get the variable overhead rate variance. So let's just do that calculation. We'll take 55,000 times 510 minus $5. $5.10 minus $5, and we get $5,500. $5,500. That is because the rate is above the standard rate. This is an unfavorable variance. So the variable overhead rate variance is going to be based on the 10-cent difference per hour times 55,000. We have a $5,500 unfavorable rate variance. And then last, we have the variable overhead efficiency variance. And this is going to be very similar to what we did when we were calculating the variance for labor efficiency variance. So we're going to have the standard rate is $5 per hour. So we have $5 times the actual hours, which were 55,000. And remember, we produced 30,000 units, so the standard hours for those 30,000 units would have been 60,000. So we do that, okay? So this is our formula to calculate the variable overhead efficiency variance. We're going to take the $5 standard rate that's given to us up here in this formula, which says $5 per hour. And then we're going to take the actual hours that we had, which is 55,000 right here, okay? We had actual hours of 55,000. Now, what we actually produced was 30,000 units, so the actual standard for the 30,000 units produced would have been 60,000 because we would have said 2 times 30,000 units. Because the standard is 2 hours per unit produced, right here. And we would take those 2 hours times the number of units we actually produced and sold. So when we do the calculation, we're going to do this $5 times 55,000. So we have 5 times 55,000 minus 60,000. And we get, I should have done that because it's going to be a negative. I don't want negative numbers when I'm doing variance analysis. But because the actual hours are less than the standard hours, this will be a favorable variance. So that is the foundational 15 for chapter 10. And I'm going to post this worksheet in Canvas. Well, it's already there. And then if you have any questions about any of these calculations, feel free to let me know. I'll be glad to help you out. Again, I'll be having office hours, except today at 3 p.m. I have a meeting that I'm going to be in. So keep in touch. I hope you're doing well, and let me know if I can answer any questions. Thank you.